Candlestick patterns are one of the most important concepts when it comes to trading profitably, yet most people still use them wrong, and that costs them money. The most confusing part? Figuring out which patterns actually work. The truth is, most candlestick patterns are unreliable, but there are a few that really stand out and can help you make better, more confident trades. We'll break down the top 7 candlestick patterns that have the highest chance of working. Plus, we'll show you how to use those patterns in combination with other tools, like support and resistance, indicators, or volume. Trading with just candlestick patterns alone? That's a mistake we'll help you avoid. Before we dive into the patterns, let's make sure we're on the same page about candlesticks. Each candlestick shows how the price of an asset moved during a specific period of time. On a 1-hour chart, one candle represents all the price action within that hour. It represents 4 key pieces of information about price movement: the open, high, low, and close prices within that specific time period. So on a 1-hour chart, one candle shows where the price started, the open price, the highest point it reached, the lowest point it dropped to, and where it ended, the close price, during that hour. A green candlestick indicates that the price closed higher than it opened, signaling that buyers were in control during that period. Conversely, a red candlestick means the price closed lower than it opened, showing that sellers were dominant. The rectangular part of the candlestick, called the body, represents the difference between the opening and closing prices. A larger body indicates strong momentum in the direction of the candle, while a smaller body often signals market indecision or a period of consolidation. The thin lines extending from the top and bottom of the body, known as wicks or shadows, represent the highest and lowest prices reached during the time period. Long wicks suggest price rejection at certain levels, while short wicks indicate stability or limited price movement outside the body. Understanding this structure allows traders to better analyze price movements. Now that we understand the basics of candlestick structure, let's dive into the top 7 candlestick patterns that can help you identify some of the most reliable setups in trading. Let's start with the engulfing pattern. For it to qualify as a true engulfing pattern, the second candle's body must completely engulf the body of the previous candle. This means the open and close of the second candle should fully cover the range between the open and close of the first candle. Ideally, the second candle has little to no wicks, as this shows strong conviction from buyers or sellers. In a bullish engulfing pattern, the first candle is red, representing selling pressure, while the second candle is green and much larger. This shows that buyers have taken control, reversing the prior downtrend. Conversely, a bearish engulfing pattern occurs when the first candle is green, followed by a larger red candle that completely engulfs it, signaling that sellers have overwhelmed buyers. On the chart, you see a bullish engulfing pattern forming after a red candle. The green candle engulfs the previous red candle, with its body completely covering the open and close of the smaller red candle. You would enter the trade as the green candle closes, place your stop loss just below the low of the engulfing pattern, and watch as the price surges upward, confirming the reversal. 2. The hammer. The hammer is a bullish pattern that usually shows up at the end of a downtrend. It has a small body near the top of the candle and a long lower wick that's at least 2 to 3 times the size of the body. The small body means there wasn't much difference between the opening and closing prices, while the long wick shows that sellers pushed the price down but buyers took control and pushed it back up. The bearish counterpart to the hammer is the shooting star. This pattern appears at the end of an uptrend and has the opposite characteristics: a small body near the bottom of the candle and a long upper wick that is at least 2 to 3 times the length of the body. The long upper wick shows that buyers tried to push the price higher, but sellers took control and drove it back down, signaling a potential reversal to the downside. For the hammer to be reliable, it should ideally have little to no upper wick, as this shows clear rejection of lower prices with no significant upward pushback. If we return to the charts, we notice a hammer forming after a sequence of red candles, its long lower wick prominently visible. You would enter the trade as soon as the hammer closes, set your stop loss slightly below the wick, and watch as the price shifts direction, climbing upward with strong momentum. The pin bar looks similar to the hammer pattern, but has some key differences. While both have small bodies and long wicks, the pin bar's wick can point in either direction. It has a long wick or shadow on one side and a small body on the opposite side. For a pin bar to be effective, the wick should be at least twice the length of the body, and the body itself should be small, ideally near one end of the candle. A bullish pin bar has a long lower wick, showing that sellers attempted to push the price down but were firmly rejected by buyers. A bearish pin bar, on the other hand, has a long upper wick, indicating that buyers tried to push the price up but were overpowered by sellers. On the chart, a bullish pin bar forms after a string of red candles, with its long lower wick clearly rejecting lower prices. You'd enter the trade once the pin bar closes, set your stop loss below the wick, and observe as the price starts to climb, confirming the bullish momentum. The fourth pattern is the morning star and evening star, both being three-candle reversal formations that indicate a shift in momentum. The morning star is a bullish pattern that starts with a long red candle, followed by a smaller candle, often a doji or spinning top, that reflects market indecision. It concludes with a strong green candle that closes above the midpoint of the first candle, confirming that buyers have taken control. For the evening star, the sequence is reversed. It starts with a long green candle, followed by an indecision candle, and ends with a strong red candle that closes well below the midpoint of the first candle, signaling that sellers are now in charge. On the chart, a morning star appears after a downtrend. The first candle shows strong selling pressure, the second candle reflects indecision, and the third candle confirms the reversal with a strong close. You'd enter the trade as the third candle closes, place your stop loss below the second candle, and watch the price move upward in a new trend. The next one is the shrinking candles pattern consists of 3 consecutive candles with decreasing body sizes, signaling that the current trend is losing momentum. The fourth candle is a strong reversal candle that moves in the opposite direction, confirming the trend reversal. For this pattern to be effective, the shrinking candles should have progressively smaller bodies, showing that the initial trend is running out of steam. The reversal candle should have a larger body with little to no wicks, signaling strong momentum. On the chart here, the shrinking candles appear during a downtrend, each one smaller than the last, followed by a large green candle. You'd enter the trade as the green candle closes, place your stop loss below its low, and observe as the price reverses direction, moving upward. The breakout candlestick pattern is number 6. The breakout pattern forms when multiple candles consolidate within a tight range, often with wicks pointing in both directions, indicating indecision and a lack of clear direction. This is followed by a breakout candle that closes significantly beyond the range of the previous candles, signaling a strong move in the breakout direction. For this pattern to be effective, the breakout candle should have little to no wicks, showing strong conviction and momentum. This pattern is easy to spot when you see a series of consolidating candles, followed by a large green breakout candle closing decisively above the range. You'd enter the trade as the breakout candle closes, set your stop loss just below the breakout level, and ride the momentum as the price moves strongly in your favor. The last one is a bar continuation pattern, also known as the rising 3 or falling 3, is a powerful signal of a brief pause in the trend before it resumes. It's a bullish continuation pattern during an uptrend and a bearish continuation pattern during a downtrend. In the classic rising 3 pattern, the setup involves a strong bullish candle, followed by 3 smaller bearish candles. These bearish candles must stay within the range of the first bullish candle, showing that the pullback lacks the strength to reverse the trend. The pattern is completed by a final strong bullish candle that closes above the first bullish candle, confirming the continuation of the uptrend. However, this pattern doesn't always require exactly 3 bearish candles. It can work just as effectively with 1 or 2 bearish candles, as long as the pullback remains contained within the range of the first bullish candle. The key is that the pullback candles do not break below the low of the first bullish candle, ensuring that the overall trend remains intact. The final strong bullish candle then signals the resumption of the uptrend. For example, during an uptrend, you might see a large green candle followed by 1 or 2 smaller red candles. These red candles stay within the range of the first green candle, showing only a temporary pause. The pattern is confirmed when another strong green candle forms, closing above the high of the first green candle, You would enter the trade as this confirming candle closes, set your stop loss below the lowest point of the pullback, and follow the trend as it continues upward. This combination of consolidation and breakout makes the pattern a reliable continuation signal. However, candlestick patterns alone aren't enough to build a reliable trading strategy. To achieve consistent results, they need to be combined with other technical tools for additional confirmation and context. While these patterns are powerful, they are only one piece of the puzzle. Let's look at a few examples of how candlestick patterns can be paired with other tools to create a stronger setup. These examples are meant to illustrate the importance of combining techniques, not to suggest strategies to trade by itself. Imagine you spot a hammer forming on your chart. On its own, it suggests that sellers tried to push the price lower, but buyers stepped in and drove it back up, leaving a long, lower wick. While this is a promising sign, it's not enough to make a reliable trading decision. Now let's take it a step further. Suppose this hammer forms near a key support level, a price area where the market has historically reversed or paused. The support level adds context, indicating that the market might once again find strength at this point. But we're not done yet. To make the setup even stronger, look at the volume. A spike in volume during the hammer's formation confirms that buyers are stepping in with force, adding credibility to the reversal. At this point, you can enter the trade as the hammer candle closes, with your stop loss placed just below the wick to protect against any unexpected breakdowns. As the price begins to rise, you can see how this combination of the candlestick pattern, support level, and volume comes together to create a winning trade. Now, for a second example, imagine you notice shrinking candles forming during a downtrend. Each candle has a smaller body than the previous one, indicating that sellers are losing momentum. On their own, shrinking candles suggest the trend might be weakening, but they don't provide enough confirmation for a trade. Now let's add more context. While observing the shrinking candles, you notice an RSI divergence. As the price makes lower lows, the RSI forms higher lows, signaling that bearish momentum is weakening and a reversal could be on the horizon. To add even more weight to the setup, you observe that volume is gradually decreasing alongside the shrinking candles, further confirming that selling pressure is fading. Finally, a strong reversal candle forms, larger than the previous shrinking candles, with a clear spike in volume. This confirms that buyers are stepping in decisively. At this point, you can enter the trade as the reversal candle closes, with your stop loss placed just below the low of the shrinking candle sequence to guard against a potential continuation of the downtrend. As the price climbs, you see a winning trade unfold. Another way to use candlestick patterns is in combination with Fibonacci levels. Imagine a market retracing after a strong upward move. As the price pulls back to the 61.8% level, a key support area in trending markets, a bullish engulfing pattern appears. At this point, the green candle fully engulfs the previous red candle, indicating a possible reversal. On its own, the engulfing pattern is a strong sign, but let's add more context. As the engulfing pattern forms, you notice a spike in volume, confirming strong buyer interest at the Fibonacci level. This combination of the engulfing pattern, Fibonacci retracement, and volume strengthens the signal. At this point, you can enter the trade as the engulfing candle closes, with your stop loss placed just below the Fibonacci level to protect against further downside. As the price moves higher, you see a winning trade unfold, showing how combining candlestick patterns with additional tools creates stronger setups and increases your confidence and success in trading.